Welcome to the Cattle Talk Podcast, your weekly breakdown of cattle market fundamentals, key news, and the insights shaping the industry. Trading commodity futures and options involves substantial risk of loss and is not suitable for all investors.
Today is March 13th. This is Jeff Hogendorn. We are missing Mike Miner here this afternoon. He's out and about doing some traveling. So we have myself and Nick Bork with us today. Welcome, Nick.
Thank you, Jeff.
I think to start off, Nick, since Mike's not here and we haven't done this much on this podcast, why don't you go ahead and give us a little introduction? You know, Nick and I have very similar jobs here at ProAg, and what we do, you know, throughout each day. Nick, why don't you kind of start us off by discussing a little bit about what we do each day and how we work with producers?
Yeah, we work with cattle producers today to kind of navigate through these markets and help make good risk management decisions. The way that's evolved today is kind of utilizing a lot of LRP and LGM to get floors on these cattle in this stage of the cycle. Yeah,
it's kind of the favorite part of our day, I think, is just those one-on-one discussions with producers, you know, analyzing the market and trying to get them in the best position we can possibly do. To get us started here, why don't we talk a little bit about box beef? And, you know, a lot of things have happened this past week, Nick. We've had movements in both the beef and the cash, and leverage looks a whole lot different than what it did 2 weeks ago, doesn't it?
Yeah, it sure does. We've had like a $50 rally in choice beef since the first of the year. You know, that's approaching the $400 level here. So we're going to test some demand early on here, or earlier than normal, I guess, earlier than seasonally normal. Usually that doesn't start kind of till that April-May time frame.
If you're watching the video here, I mean, he's got the chart up there, and it really looks, you can see how abnormal this rally is right here in this time of year, can't you, Nick?
Yeah, for sure. So obviously, cash cattle dropping a little bit this week, now down to 235. Packer margins have definitely increased here. I know you're going to talk a little bit about that too, Jeff, but we're definitely seeing kind of a leverage shift here.
Yeah, and I think we're, you know, to follow up the demand discussion, you know, everybody's been nothing but impressed how well the U.S. consumers been willing to take on these higher beef prices in the past, you know, 12 to 18 months, right? But we do continue to push that envelope and keep leaning on that portion of our business, I would dare to say. So, I mean, if you think about retail prices, I know we've talked about this before too, but they're going to continue to go up this year. What Nick was referencing with those choice box beef values, you know, this sharp increase, early in the season, it's going to get really interesting. Do we see retail prices do something similar to that, maybe even before you get to the time of year where you can really expect to experience that demand, right? As you get into that mid-April into May, June time frame and start looking at some of our grilling season. So that's what we're going to be watching awful close on the demand side of the thing. What I wanted to talk about a little bit, and Cade, maybe you can throw that weekly slaughter or weekly harvest chart back up there. You know, Greeley, Colorado, of course, is experiencing some downtime here and been dark this week. Looks to us, at least, and things can change. It's a fluid situation. It looks like it sure might be dark into next week, too. So it has us, you know, kind of asking the question of, okay, is this really a bottleneck? Is this really a problem? You know, so where we can get into some really disappointing markets is when we can't physically get the animals through the plants in a timely fashion, right? And of course, as you think about big cattle, some numbers that are probably backed up a little bit, been on feed, you know, much longer than what they're used to being on feed. So the feedlots are, you know, looking at some limited availability as far as how long they can keep them around. That's where you can get into a really dangerous situation. So we spent some time on the numbers, been killing somewhere in this 520,000 a week type of a time frame. You know, if you think about Lexington plant closing, Amarillo plant being cut down to a single shift, and then now we've got the issues at Greeley. But the way it looks to us, we can still be killing somewheres in that 570, maybe 580,000 a week, really easy, like Monday through Friday. And you can kind of expect, to add a little bit of Saturdays. I think we're going to start seeing just a little bit of Saturday kills coming in here, maybe 20 to 30,000. So it looks like 600,000 a week or on all total cows, calves, and fed animals seems to be a very reasonable kind of low water mark. It shouldn't be too hard to accomplish those type of kills. So we're sitting here down at 520, 525. There should be plenty of room in there. We shouldn't be experiencing a really big bottleneck as far as total available shackle today. Nick, that goes back to the whole leverage discussion. If you want to, hit on that a little bit further as far as packer margins go and what you think might happen here as far as leverage between packers and feed yards.
Yeah, I think that's kind of the question going forward. Obviously they've gained some leverage back here this week with boxes moving to where they have and the cash price $5 lower in that 235 area this week, which it does look like they bought about 30. We're able to buy about 30,000 head yet, primarily in the north, obviously. But I think as you go forward too, it's going to be interesting to see how long or how comfortable they are staying kind of at these kill levels, because we're likely not killing enough, at least relative to the available supply for the year, right? The number of cattle that we ought to be killing weekly. And it's going to be kind of questionable, I think, how willing they are to stay at these levels, even though their margins may be creeping back. Already this week, like you're saying, Jeff, we're going to kill 17, 20,000 on Saturday. So they're already willing to step that up a little bit. Some of that has to do with the Greeley deal, but I think if they maintain these harvest levels, even as their margins are coming back, we definitely could see a more severe loss of leverage. I'll say it that way in that April-May time frame, and that will kind of be the key, because I think if they gain leverage back in that time frame, then they're probably able to keep that going into the summer and fall.
Yeah, I like the chart that Cade had up there here a few minutes, and maybe he'll throw it back up there for us. That there's been very few times over the past 12 to growing on 14 months here where our model was suggesting that packers had a positive margin. Really it's a couple times last summer, early fall there, and then of course that November time frame when futures really went down off of some of the administration's discussions on trying to lower beef prices, right? That let them buy some cash cattle cheaper for a bit. Most of those were very short-lived, but we really didn't see a huge increase in shackle speeds. A slight one maybe in July there, a slight one in September. The really big one came back in November. They really increased their kills, and it looks like that might have been a mistake. And I don't know if that was just because they felt like the cattle were a really good buy at those type of price levels. That's certainly the price action that we've seen after that event. That's the way that looks. But that's why it hasn't stuck. The positive margins from the Packer standpoint haven't stuck around very long. It's going to be really interesting what they do with this time around. If they add some to the kill, which we talked about, they got plenty of room to do that, and we're really low levels. And then how do cash prices respond? All those things above are going to be some things to watch here really closely over the next few weeks.
Yeah, definitely. I think too, like when you look at today's domestic supply of beef too, like we're importing 11-12% of our supply, and that slowly dwindles here as you go from here on out through the year. There's some quotas from from Argentina and Brazil that get hit early on here in the year, and so those imports slowly dwindle as we go from here. And so packers are going to, from that perspective, we'll have the ability to take choice even higher just because more of the domestic supply has to come from our own supply, unless we make some, drastic changes to the whole import schedule there. But we'll see how that goes. And there certainly is talk that, choice can move into that 450 level here, even once we hit the heart of our of demand going into grilling season.
Some pretty good demand signals there, considering how much we're importing, the prices that we're importing it at, and the consumer seems to want to continue to chew through it. No question about it. The item that we've missed here this week a bit, Nick, is the whole Iran situation and the energy markets, crude oil, and driving these equities up and down this week. And cattle have been very much tied to that situation. I think that's a topic we'll probably leave for next week, quite honestly, and hopefully get into that discussion in the next time that we're around. Other than that, appreciate everybody tuning in. There is a link in the description below. If you guys are interested in more of this type of content, go ahead and click on that. Otherwise, everybody have a good weekend.
Thank you.